Now, why is cash on cash return so important for investors looking to invest in Myrtle Beach Oceanfront Hotels? Well, guys, I am glad you asked. Cash on cash return is one of the most critical metrics for hotel investors because it measures the actual return on your invested cash. Now, not just the property's overall performance, which is a big distinction. It helps investors determine if an oceanfront hotel investment is worth their money, time, and risk. Essentially, it provides that snapshot for you to compare investments. Do I want to put my money in this hotel, or do I want to put my money in the stock market? I'm seeing the actual cash on cash return, so I can easily assess where my money is going to be worth my time and all the risk I'm going to take. All right, guys, so let's dive into what is cash on cash return and how it's calculated. Well, essentially, you'll take the cash that's coming out of that deal and divide it into the initial cash that you've got in the deal. That's a very simplistic way to say it. Now, a higher cash on cash return, let's say 10 to 20%, is a strong investment. That's great leverage. One way to think about it is it's a cap rate that factors in leverage. And when I say leverage, I mean financing. So if you can clear 10 to 20% on an investment and it's leveraged, you're using someone else's money to be in that investment, man, that's pretty great in my opinion. Now, a lower cash on cash return, which is below 5%, it really could mean that it's a weaker return and it might be a poor investment. Now, an example is, let's say that you go ahead and buy an oceanfront hotel for $5 million, putting down 25%. Now, that's $1.25 million of your own cash in the deal. Now, after expenses, mortgage, and taxes, you have $250,000 in net cash flow per year. Now, your cash on cash return would be that $250,000 divided by the $1.25 million that you paid down on that loan that you've got in the deal, your actual cash that came out of your bank account and you put into that deal. Now that's going to equal 20%, which is a great return. Now, unlike cap rate, cash on cash return accounts for financing, making it a more realistic measure of return for leveraged investors. Now, cash on cash return, it does help investors compare leverage strategies. And I super like this one. I like this one a lot because it really dives into the nuts and bolts of the investment and you're really getting granular, making sure you're making the best move. Most oceanfront hotel investors don't pay in full. They finance a portion of their purchase. Side note, it's always smarter to use someone else's money. It will increase your internal rate of return or your yield on the investment. Anyways, if I've got $500,000 in the deal and I bought the whole thing, yeah, I don't have a lot of risk necessarily, but if I can pay 20 or 25% down and I've only got $100,000 in the deal, well, I can go take my other $400,000 and do something else with it and make more money with it. It's just a smart move. Anyways, I don't want to get off topic. Cash on cash return helps compare financing options, which is super cool. We're talking bank loans versus like SBA loans versus like private lenders. You can run different scenarios on your investment based on the loan terms and see how you come out. Investors can see how different loan terms like interest rates, down payments would impact your profitability. Now, for example, using a smaller down payment may boost your cash on cash return. If, and this is a big if the debt is manageable in the investment. Now, cash on cash return helps determine if a hotel is a good passive income investment. Now, Myrtle Beach hotels require high capital and management effort. So investors want to ensure that they get a strong return on their actual cash investment. Now, if the cash on cash is below 5%, in my opinion, you're definitely tying up too much capital with minimal return. Guys, you can just turn around and go put it in treasuries for like 4-point-something% and not have the risk. Why would you tie up all that capital? Doesn't make sense. If the cash on cash is 10% plus, your investment is actively making your cash work for you. And that's what you want. Now, let's compare three different hotels. We've got Hotel A, Hotel B, and Hotel C. Hotel A has a $5 million purchase price with a $1.25 million down payment. The annual cash flow being $250,000. The cash on cash return for that one is 20%. Hotel B, $8 million, that's $3 million more than Hotel A, has a $2 million down payment, $200,000 in net cash flow or an annual cash flow, and then it's got a cash on cash return of 10%. And then finally, we've got Hotel C, $10 million. That is $5 million more than Hotel A and $2 million more than Hotel B. It has a $3 million down payment on it. You got a lot more money in this deal with an annual cash flow of only $180,000. That's got a 6% cash on cash return. So, bigger is not always better. More expensive does not always mean it's going to be a savvy or a more worthwhile investment. Please save yourself from that thinking. Using the cash on cash return metric and the other metrics like gross rent multiplier, acquisition cap rate, internal rate of return before taxes, and then even net present value. These are 6 metrics that you need to be using. They're vantage points for you to evaluate your investment, your commercial deal. You should be using these metrics on your deal to make sure that you're doing the proper due diligence. And if you don't know how, you can pick up the phone and call a broker who does. 843-360-1737. Let me help you make savvy investment decisions when it comes to commercial properties in our market. Now, it goes without saying, but Hotel A is obviously the best move out of those 3 options. And it was the cheapest one. So bigger is not always better. More expensive does not always mean a higher profitability. Now, guys, I really enjoy this next one. Your cash on cash return is going to help you identify opportunities to increase return on investment, especially when that number doesn't work out the way that you want it to work out. Now, hotel investors I'm going to dive into that in just a minute. Hotel investors can improve cash on cash return by negotiating a lower purchase price. This one is huge. Man, it's huge. And we definitely hit on this a lot whenever I talk about net present value. If you've got a discount rate, if you've got a hurdle rate, if you need to get 15% ROI on a deal, well, guys, one of the fastest ways to increase that ROI is to buy the property cheaper. It's that simple and that easy. So you definitely want to negotiate a lower purchase price. And we've heard that, guys. Like, we have heard time and time again, you make money when you buy. The old adage is true. It doesn't go away. All right, anyways, hotel investors can also improve cash on cash return by optimizing room rates and occupancy. Obviously, if better management comes in, takes over, they remodel the place, they market it better, they increase occupancy. There's all kinds of things that they can do. But the point is, if you can increase those annual cash flows, then it's going to increase your return on investment. And then you can also reduce operational costs like utilities, staffing, marketing. They're again, more efficient and more effective hotel operators can come in and make a horrible business or a sinking business or a subpar mediocre business sing. Another great way to increase that ROI. Now, you can also refinance for better loan terms, for sure, absolutely. If your cash on cash return is low, you may need to restructure your deal to make the investment more profitable. That simple, that easy, and there are lots of things you can do. All right, now cash on cash return is very important for your exit strategy and for future sale, that resale value. A high cash on cash return obviously is going to make your hotel more attractive to future buyers. If you improve the cash on cash return from 6% to 15%, you create a more valuable and easier to sell asset. It's that simple and that easy, guys. Now, an example exit strategy would be you buy at 8% cash on cash return, you increase revenue, refinance, or sell at 12% plus cash on cash, and then you pocket the profit. Guys, it's the same thing with, we see this with fix and flips, we see this with oceanfront condos. I know of an oceanfront condo investor that bought a property at $150,000. They owned it for, I think, 2 years. They made it was a one bedroom. It was over at the Caribbean in Myrtle Beach, South Carolina. It made $72,000 in gross rental income. A one bedroom unit, by being able to show that they were able to produce that level of income for the property. The profitability on it was like $38,000. They paid $150,000 for the condo. They remodeled it. They brought in great income, and they turned right around and sold it at a premium, and made about $88,000. They bought it at $150 and sold it at $268. This is the same exact principles that we apply here with commercial hotels in our market. You come in, you buy a ran down hotel, you put the money in it, you fix it up, you market it well, you run it well, you make the changes, and when you have strong numbers, it's really easy to sell that property to the next investor. That simple, that easy. Same principles, different scale. Cash on cash return is an essential metric, guys. It's one of those real world metrics that accounts for financing, making it more practical than using just cap rate alone. Now, it's great for evaluating Myrtle Beach Oceanfront Hotels, just for the simple fact that it tells you how efficiently your invested cash is generating income. Guys, you want to aim at least for a 10 to 15% return, cash on cash return for your oceanfront hotel right here in Myrtle Beach, South Carolina. Now, guys, I get calls and emails every day from investors just like you looking to invest in Myrtle Beach, South Carolina. If you are looking for commercial properties in our market, let's say that you're looking for office space, you want to buy an oceanfront hotel, you want a multifamily property, you're interested in a duplex or some industrial property. No matter what type of commercial investment, I want you to know that I am a CCIM candidate, and I am more than happy to run all of the analysis for you, to build the spreadsheets and the models to make sure that you have had adequate due diligence done on your deal. Metrics like cash on cash return, metrics like gross rent multiplier, metrics like the before tax internal rate of return, the after tax internal rate of a return. We will go through the time value of money and make sure that you're making a sound investment through net present value. I'm talking about, the handful of metrics that we can simply run on the back of a napkin to make sure that you're making a sound and that your initial look at the investment is sound. So that way you don't get into the deal and find that you're wasting a ton of time, because the resale value on the property 5 years from now is not going to make you the kind of appreciation that you need to make when choosing between the stock market and commercial. So you need somebody that's in your corner like that, that's going to really do the due diligence for you and make sure that you're getting a really great value, and that you're not leaving any cash, taking too much excessive risk, and wasting your time looking at deals that really won't get you what you need. So give me a call. It's 843-360-1737. I'm Brandon Kunasek. I am a local broker right here in Myrtle Beach, South Carolina. And again, I am a CCIM candidate. So I'm the commercial guy that you need to get your deal done.